Welcome back, everybody. Our topic: when a great company is not a good stock. This is your host, Dr. Paul Price, for Options Profits. Brands you know and love can be appealing. Why is that? Because it feels good to own a stock when you like a company's products or service. When you know what they do, it seems easier to evaluate the stock than something technical that you might not really know what they're doing or how they do it. When you drive around town and see your company, it makes you smile, makes you feel good inside knowing that I own some of that stock. Yum Brands has shown very nice growth. Here's the 10-year view from the year 2000 to 2010 and how they did on a per share basis. The per share sales more than doubled. The per share cash flow was up over 154%. The per share earnings went up 178% on the nose. The dividend went from no dividend to 88 cents in 2010, and it's already been raised again to $1 annual rate starting this year. The book value went from a deficit to a positive 336. This is all good news. It's the sign of a good company that's well managed for the long run. So nothing wrong there. And Yum is due to report earnings on July 13th this week. And the full year estimates for this year and next year are now running 284 and 318 on earnings per share. So, why would we not want to own Yum Brands when it's such a nice company? Well, here's the reason. Yum's 10-year median multiple has been 17 over a long period of time. At last week's close of 55.61, it was 21.55 times the trailing earnings, and I gave them credit for the June quarter based on the estimates because that quarter's in the books already, and it's still 19.6 times the full year 2011 estimates that are out there. So whether you use the trailing P to E or the forward P to E for this year, it's well above its normal valuation. In the past, when it was well below normal at 10.9 times earnings in late '02, you had a great run with the stock. When you bought it a couple points below normal at 15.1 times earnings, you had a really good run, but only because it got very overvalued. It went up to 24.3 times earnings in late '07 when the market peaked, and people who bought then saw the stock go down dramatically in the next 4 months. They got one more chance to get out at a high point at 21.8 times earnings before the stock got crushed with the whole market at the end of '08. At the end of '08, though, you had the second best time in history on a valuation basis to buy the stock. It was just 11.3 times earnings, and you can see what's happened since. But the only reason it's gone up quite so much, it's reached overvalued levels again. What have the insiders been doing with the stock? Since January 1st, this is every insider trade that's been reported, and they have been selling in January, in February, March, April, May, June, July. These people who run the company said, get me out. All the sells are on these red bars tells you the volume of sales, and all the blue tells you the buys, but there's no blue. Nobody's bought. Everybody's been selling who runs the company. So, what are Yum shares really worth? That's really the question you have to ask before you can know what to do with it if you own it. Morningstar and Standard & Poor's each see fair value very close to today's price. Morningstar has a $56 fair value compared to $55.61, and Standard & Poor's actually says it should be lower than it is today at $53.50 at this moment in time. Standard & Poor's has a 12-month goal of $57, but gee, is that very exciting when the stock is $55.61 already? How does Value Line see it? Well, they're projecting a 17 multiple, which is equal to the 10-year median, P to E, for their 3 to 5 year price target. And if you apply that 17 multiple to the expected 2012 earnings, we're talking now 18 months away, you'd only be at $54 to $55, slightly less than the stock is trading for today. So all the good news is built into the price for the next year and a half, as far as I can tell, if the stock goes back to what's been its normal valuation. Where is the upside from today's quote of 55.61? I don't see any, and I don't think you would either if you did this kind of analysis. So, what have we learned from all this? What concepts do you want to remember from this little lesson? The only reason to own a stock is because you think the shares of that stock are going to go up. Stock price movement is most predictable when the fundamentals of that company are well above, either way higher or way lower, than that same share's own normalized valuation metrics. The further above or below normal the stock trades currently, the more likely it is to regress towards the mean. Paying well above typical valuation for momentum stocks is very risky. Conversely, buying at bargain valuation levels often pays big rewards, as you saw in the chart, and has less risk than doing that momentum trade. And shares trading at fair value offer the worst predictability, because if they're trading for where they belong, based on all available information, how can you predict whether they're going to go up or down? It's probably going to be based on some kind of surprise, and if it's a surprise, you can't predict it. Thanks for joining me again today. This has been your host, Dr. Paul Price, for Options Profits.